welcome to a very special episode of the podcast. Today, we're delighted to be joined by Georgina Brittain, manager of JPMorgan UK Small Cap Growth and Income. Now, this is a trust which seeks to deliver capital growth over the long term, and it's also a quarterly dividend payer. Georgina, thanks for your time today.
Absolute pleasure.
Now, JUGI is one of the best 10-year share price total return performers in the sector, isn't it? What's your secret sauce? Like, what sets the trust apart from rivals in quite a competitive patch?
Well, thank you for the compliment. And just to say immediately, we call it JUGI. That's the name.
JUGI.
I've been giving this a little bit of thought. So, I mean, there's the kind of really obvious things which I'll turn to in a moment. But really, truly, what we do, we've got a process, we have an investment philosophy, and we have discipline. So we follow that at all times. You don't say, oh my goodness, there's a war on, or there's a crisis, or there's whatever on earth is going to hit us tomorrow. We follow our process. We also have some pretty serious positions. We can go up to 5% active. So where we have conviction and that will grow over time, then we really, really believe we understand the story, the momentum behind that story, and we will have conviction regardless of what the market may or may not be saying that day, that week, that month. In addition, I think the one other thing we really, really do is we don't buy hype, we buy numbers. We are really, really methodical. We go through the numbers, we go through the balance sheet, we go through the P&L, we go through the cash flow, crucially. We buy the numbers. So when new management comes into a story, as will often happen in our area of the market, when things have been going wrong, he or she will talk a great story. Shares will go up probably 20% during that time. We will be watching, waiting, listening, but we're absolutely not buying because that's all hype, all noise, and we're buying when we start to see that, if we start to see that come through in the
Georgina, I remember from several years ago, when I was working somewhere else, we had a conversation, and I was asking you about IPOs, and you said at the time that you often avoid IPOs because you want to see the company perform first, and you'd rather miss out on some of the early returns rather than go into a young business. Is that still the view?
No, that is, I'm just going to suggest I've never said that, because we do IPOs. I've done a lot of IPOs over the years, and we actually really like the idea of IPOs, and obviously we all love new companies coming to market. But our track record suggests we're pretty good at choosing which IPOs, and when we make a lot of money in general out of it. So that really isn't true. But what we're asked is, given you've got this process and you like to look at the numbers and everything, how do you go about investing in IPOs? Obviously, we do a huge amount of legwork behind the scenes. Obviously, meet the company nowadays probably a couple of times or 3 times or whatever it is. But our mindset is identical to the quoted companies, obviously, without sort of the track record. But you're really, so the thing we're looking for, I'm obviously looking at the numbers, the valuation, the story, the growth trajectory, but we are also looking at, numbers now. Where are they cautious? Why are they cautious? Yes. Are they stretched to get a highest allocation, highest price? And those will be, so again, to the extent that we can do. What we won't know, so we will never go large on an IPO at start, because you just don't know. You don't know management. You don't know if they're going to exaggerate or be sensibly cautious and all that kind of stuff.
Yes.
So over time, we can, IPOs get to be one of our largest, if not our largest stocks, but that will be over time as they prove themselves and prove themselves to us and the market.
Great, thanks for clearing that up. I suppose then the raison d'etre really is you're targeting quality companies that have a bit of momentum going forward. So they've already started their recovery journey or their growth journey. Are you seeing lots of opportunities in the UK market at present?
Absolutely. So it's interesting. One of the questions I'm asked so much at the moment, I'm sure we will talk shortly about M&A, but obviously there are a lot of companies leaving the market, and there are not enough coming to the market. Sure. So I'm often asked, it's great when we get an M&A, we get a bid at the right price, crucially. But I'm asked, you worried about a shrinking universe? I can honestly say, so our benchmark is the new Miss Smaller Companies plus AIM. That's of the right kind of size. That's almost 1,000 companies. Right. Choice is something we really have. Within that, at the moment, coming back to your actual question, yes, absolutely. We are inundated with ideas of things that we don't own that we need to be either buying or doing the work on. There is so much opportunity because, as we all know, the UK in general and the UK mid and small caps are so undervalued.
Excellent. And do you have any preferred valuation metrics? And if so, why are they useful? What do you kind of favour?
I love this question because absolutely. So very clearly, it's always horses for courses. You've got to look at different metrics for any different kind of company. And if you're looking at oil E&P or whatever it is, but in general, absolutely, the preferred metric is free cash flow yield. So we want to know, that how much cash a company is producing over and above its needs, and it's really a crucial figure for us. And when I say that, so we look at our overall portfolio and we measure the free cash flow yield on it. Twice this year, it's been almost 10% historic free cash flow yield. Today, when I checked, we're on sort of circa 8.5. So clearly has come in a little bit. As you both know, I have been doing this a very long time, and I'm telling you, a 10% historic free cash flow yield. Normally, that's like for a company that would be shrieking lights, like something is really going wrong here. And this is a beautiful hand-picked portfolio of lovely stocks. And as I say, we're at 8.5% historic. Guess what? All our companies are producing more free cash flow this year than they were last, so the number goes up. So we absolutely look at it, so I say, on a portfolio basis, but on an individual company basis, because free cash flow does not lie. Out and out, strong metric.
So here's your M&A moment, Georgina. I mean, we've all worked in the markets for a long time, and we've seen over the last decade a big hollowing out of very high quality UK companies, and they've either gone to private equity or they've gone to overseas peer buyers. It's just a shame because there are there's not been the IPO tax to replace those companies. It just makes it a shrinking market. What are the challenges in the M&A space in your regard, and how do you perceive the IPO market? Do you think that's likely to lift at some point in the coming years?
Okay, I'll touch on IPOs second. So first of all, on the M&A, so we had a very good year for M&A last year, by which I mean, we got great prices for a number of our companies. The whole point for us is, am I getting paid tomorrow or tomorrow's price today? Exactly. If so, fine. And some of our large holdings got taken over at some very satisfactory premiums. So that was positive. Absolutely, what we do not ever do is own a company because of M&A, because we think it's likely to get bought.
Yeah.
I mean, at the moment, it seems to be the entire market, so that's fine. But, that is, I mean, you can wait 10 years and never get the bid or whatever it is. There are incredibly rare exceptions where, we've got something in the portfolio that, let's suggest, might be on its way out. It's not really ticking our boxes anymore. If you get a bid for the stock like that on the day, fantastic, take it. But we absolutely, we personally, will reject bids.
Yeah.
That's one, but maybe I'm a 5% shareholder, whatever it is. If the valuation isn't right, it is about, it's numbers at the end of the day.
Yeah.
So, and I mean, very clear. I mean, what's fascinating this year is we've had less, but it's going all the way up the market cap scale now. You've got FTSE 100 companies getting bought. And again, all I can say, I mean, I am a broken record on this, but all of this underlies the fact, as we all know, that the market is too cheap, and the individual stocks, almost all of them, are too cheap. On the other side, so IPOs, I am a bit of a broken record. So I speak a lot to sort of corporate departments of investment banks, because I want to get a feel for what's going on and what might be coming. And I mean, how many times have we all called false dawn? And we absolutely, at the start of this year, and I was hearing about the pipelines, we were doing early looks, etc., back end of last year, start of this year. It really was opening up. I'm not suggesting it was a flood, but it was definitely, there were a number of companies lining up to really seriously consider floating. And then, of course, we have a war. So as you can understand, that puts it, and each time it looks sort of positive. At the moment, some extraneous factor comes along. But so there are these companies that definitely, they would have floated by now if it hadn't been for the war. And also, I will say, so I actually, as I said earlier, I'm actually very keen on IPOs, and I'm asked to do quite a few. I do quite a few sessions. The most recent one was at the London Stock Exchange, where I talk to companies, up on stage, and I talk to companies about what investors like me look for in an IPO. And the most recent one, I say I've done 2 recently. A lot of people are listening. I mean, one of them, there were north of 250 companies listening.
Wow.
That's a lot of companies. Maybe some of them never. Well, some of them will definitely never do it. Some of them, maybe they're thinking 3 or 4 years time, but some of them would be much more close. So just slowly, momentum's building. If we stop getting sideswiped by extraneous events.
Yeah.
Excellent. And given that you're seeing so many opportunities, what have you done with the gearing on the trust? Have you sort of ratcheted that up a bit, and how does that stand kind of relative to history?
Well, actually, as of today, we're very, very much circa 10%, which is becoming over this last several years is pretty much our norm. I keep going on about how cheap the market is, and I'm going to say it once more. So you could easily say, why aren't I, pushing that number higher? We are in the middle of a war. I mean, we're not, thank God, but there is a war going on. The markets are even more volatile than we've all grown used to. That feels to me, I've got that gearing in place because these company valuations are so compelling and the companies are delivering so strongly. But you've got to be mindful of the wider world.
Right, yeah. And just looking at the top 10 as well, Premier Foods stands out as that top holding. Given all the noise around the consumer and perhaps perception among investors that it's kind of an indebted business, what do you like so much about it? And just talk us through the bull case.
Absolutely. Well, I'm just going to say, first of all, it's so interesting because for literally several years now, my number one holding has been Lion Finance, which is a very, very successful holding for us. And that obviously has now gone into the FTSE, so it's sort of coming down in our weightings. But Premier Food, exactly. There are a lot of reasons, very clearly, that I'm very, very keen on this. But you touched on one of them when you talked immediately about an indebted company. So back in the day, way before we were involved, clearly, Premier Foods, let's not go into history, but they definitely overpaid and overgeared, and it all went horribly wrong. The market in general, a lot of people don't understand that by this year, I think it's going to be net cash. It's got gearing of 0.4. For a daily staple company, that is absolutely, utterly in the past window. Likewise, with that fateful acquisition that they did at least a decade ago, there have been pension issues for a very, very long time. And again, it's like what do people used to say about British Airways? It's a pension fund with an airline attached, kind of thing. And this was almost the same. Again, now in the rearview mirror. The rating, however, does not reflect the fact that those are past issues, and obviously nothing at all to do with current management who've been extremely able. It's interesting because that's what you mentioned. The other thing that it's had a sort of little wobble over the last year or something was because of, I'm going to get it wrong, but whatever they call all these Wegovy and all these weight loss drugs, and the market perception, for what it's worth, was that that again was going to harm Premier Food amongst a whole lot of other companies. And again, the way we think about it, and definitely the way management talks about it, is that actually they see themselves as a potential beneficiary, because if you're very seriously taking all these weight loss drugs, you will be eating out less often because, well, A, you can't probably afford to, and B, and that wasn't glib, that was sad fact of life, but also because you don't need those kind of portions, you don't want that kind of temptation, so therefore you eat more at home. Premier Foods gets advantage on that. That's the kind of large background of it, and then just in terms of literally day to day, this is hello, yeah, okay, sorry, I lost you for a second. This is day to day products. They do. Oh, sorry, 1 second. I can't find you. Sorry, let me just find you because
we're still here.
Okay, good. No, good. Well, I'm just like
we can still hear you fine.
Yeah, sorry. No, the whole, because I'm so busy talking and not touching the screen. So sorry, what was I saying? So no. Then in terms of just day-to-day delivery, I mean, new product development, just absolutely. This is about you've got to run these companies superbly, just to keep going. And then the icing on the cake for us is M&A. They absolutely are not going to go back to the past history and basically put the whole company at risk. So these are small, very, very cute acquisitions. They've done 2 or 3 in the last year or two. The execution's been superb, the growth's been superb, and we see definitely with the balance sheet where it is, more of that to come. So, just one of those companies that the market absolutely has failed to look at properly.
Well, I think on that note, Georgina, we can all drift off and have our Mr Kipling cake each, and pat ourselves on the back, have a nice little cup of tea. Thank you very much for your time. That was an illuminating conversation. Thank you, listeners, for tuning in as always, and keep tuned in for new podcasts coming up with us very soon. Until next time, take care.